Have you heard lately all the new trends about discounts for buyers when buying a home? Have you heard of 3-2-1 buy downs, 2-1 buy downs, maybe adjustable rate mortgages being thrown in there, all kinds of creative financing that's being tossed around. One other thing that comes up in these conversations is assumable loans. Today we're going to dive into why assumable loans probably won't make a comeback, but we'll see. I'll tell you why I think that they're a little bit far-fetched. What's up, everybody? Jeremy Kane, eXp Realty. So excited to have you here. As always, please like and comment, subscribe. Let me know what you hear that kind of spurs your interest. I am offering a free buyer consultation to anyone who's renting or a homeowner that's looking to move in the next 2 years. So please check out the link below. It's a Calendly link. It'll book straight in my calendar, and we can dive into your situation to make sure that we are making all the right moves in the years leading up to your move, or the months, or maybe the days. But absolutely would love to chat with you because, as I always say, real estate is hyper local to you, and your situation may be very different than what we talk about to the masses. So let's dive in here. Assumable loans. First things first, realtors, everybody listen up. Conventional loans are not assumable. And so that takes a huge amount of loans, especially that we've been doing lately, off of the table. Over the last 2 or 3 years, buyers have unintentionally been pushed into getting conventional loans. This is because the sellers were less likely to accept your offer in a multiple offer bid if it was, a government insured loan, and that's FHA VA USDA loans. And so if they're less likely to be accepted, then people would try and gravitate into that conventional box. Conventional loans are not assumable. So that takes a huge number of loans, especially because we couldn't get under contract a lot of times with FHA and VA buyers over the last 2 or 3 years, at no fault of the buyer, but it's just kind of how it trended. A lot of realtors would say they're not taking FHA and VA loans, which I thought was absolutely crazy. I have other videos on that. We don't have to dive into that. But with that said, the majority of loans over the last few years have really trended towards the conventional way. So that means there's less assumable loans out there on the table to be assumed with those hyper low interest rates that we saw over the last 2 years. So that's the first thing. The next thing is, we've also seen over that time, over the last 3 or 4 or 5 years, we've seen huge equity gains. And when you have an assumable loan, you have to you just assume the loan for where it's at. So say I purchased a home for $350,000 and it's now worth $500,000. Okay, I have the equity gain that I have to bring to the table in cash, because as a seller, I'm not going to leave that on the table if I'm the buyer. And if I have the equity gain and then I have what I've paid off over the last year. So if it's been 5 or 10 years, it could be $20,000, $50,000, $100,000 of principal that I've paid off over that time. So in order to assume that loan where it's at today, say my loan balance on that $500,000 house, $350,000 original purchase amount is $300,000. That means I have to come up with $200,000 cash for the down payment and then pay whatever fees are associated with the assumable loans. And that kind of goes to the next point. Assumable loans have to be dealt with the servicer. So you're dealing with the bigger banks, the Wells Fargos, the Chase, the Regions, the Mr. Coopers, all of these people that service the mortgages. You cannot go to a lender or have an advocate to understand what is really going on in this situation. So if you do go down that route, say you do have the money and you're ready to roll, that's absolutely positive. So with that appreciation gain mixed in with the time that we've paid it down, that's made the down payment for assumable loans quite large. In the event we do see prices dive sharply, which I highly do not expect, this could come into play a little bit because you're going to need less cash. But the next point is, assumable loans are always not great for one or the other parties, and it varies between FHA and VA. For VA loans, if you're going to assume the loan, you do not have to be a veteran. However, you do have to pay the 0.5% funding fee. But the scary part happens with the seller. Say your loan is assumed by somebody who is not a veteran and does not have eligibility for a VA loan, then your eligibility as the seller is affected until that loan is paid off or sold. And so that's not sold to a mortgage, but say the property is sold. So once that mortgage is paid off, then you would retain that eligibility moving forward as the seller. Another piece of that is in the event the loan went to default, your eligibility could be affected as the seller who's not even defaulting, but your eligibility, future eligibility could be affected by that. So that's kind of a risky situation. You're kind of leaving your eligibility and what you've worked so hard for and served the country for to somebody else. And so the VA loan product is a great product. That 0.5% funding fee sometimes gets in the way. That's just more cash out of pocket, but really it's all about the eligibility. And you can, like I said, give it to somebody that is not a veteran. In the event you do give it to a veteran, they can use their eligibility and you would retain your eligibility moving forward. So that's just one reason why for the seller, the VA seller, especially that long-term commitment to, somebody else paying the payment, that's a little scary. And then obviously the eligibility, which could affect your family, whatever, because you can't go get maybe a VA loan as big as you wanted to. So that's the next step. Now let's transfer to the FHA side. FHA, there's not a upfront funding fee. I'm sure there's some fees associated with the servicer and all of that, but what there is lifelong mortgage insurance. And the only way to get the mortgage insurance off of the FHA loan is A, to pay it off, or B, to refinance. If you refinance, you lose the interest rate that you're doing this all to get. So that's another reason why, if you have $200,000 in the scenario of the $300,000 owing and $500,000 home, if you have $200,000, you can probably do something a little bit different where you're not going to have that mortgage insurance. I have people every single day come to me and be like, I don't want to pay mortgage insurance. Even when they understand you can get into a home for less, of a down payment, that's a huge sticking point. And so if you have $200,000, you absolutely do have an option to get a loan that does not have that mortgage insurance for the life of the loan. So it's almost like that kind of eats into that, and all this little things eat into that savings that you're going to get for the lower interest rate. And ultimately, I'm not sure that this is something that's going to take off because of all of these overlays and these things that are happening. Just wanted to come to you guys today and talk to you about that piece specifically, because I know a lot of realtors, a lot of lenders, even a lot of people are saying, oh, these assumables are coming back. Oh, these assumables are coming back. Well, first of all, there's not very many. Second of all, the appreciation gap is so great right now across the country, but especially in Denver, that it's not going to happen. And third, the assumables always have a little bit of skin in the game for both sides. It's always not super comfortable. So if you're interested in knowing more about these, or just want to sit down and look at your entire situation, I'm telling you right now, as a buyer, now is your time to get into this market and quit renting. I don't care what you're renting or what you're doing. If you're renting, you need to be talking about buying. And it may not happen tomorrow, but it needs to happen soon. And we need to start that journey right now, because by the time you're ready to buy, the market could be completely flipped on its head. You'll have a lower interest rate maybe, but you'll be paying higher prices for the homes. So as always, please reach out. Please like, comment, subscribe. Hope you have a great day. Let's go.